Attendees are in listen-only mode.
Good evening and welcome to tonight's Premium Account Short Form Market Update. The information prepared for general information of traders and investors. The information does not take into consideration the specific needs, investment objectives or financial situation of any person. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter tonight, myself, Leon Hein, current Managing Director of Global Equity Management and the Investment Manager for the Investor Signals Unit Trust. The format for this evening's presentation, we look at a quick summary of the global macro outlook. We look at last week's earnings results covering AMP, Goodman Group, Wesfarmers and Santos, and then we look at this week's results in Amcor, AZJ, Coca-Cola, Oil Search, QBE, Sonic Health, BHP, Suncorp, Sydney Airports and Woodside Petroleum all reporting today. We review our equity buy orders and derivative strategies as a result of the last week's trading, so continuing on from the themes that we discussed in last week's recording, and conclude with a short-term Australian market outlook. The services that we provide are up on screen there, and if you'd like to know more about those, please contact myself or Christine, info@investorsignals.com. Moving straight into a graph of the XJO. So from a valuation standpoint, I've spoken in previous recordings where we've looked at the valuations of the S&P 500. The Australian market on a forward earnings outlook into 2014, we have it tracking at around 14.5 times earnings, 14.5, 15 times forward earnings. I've spent a lot of time chatting about, obviously, the driver of equity markets at the moment. We're seeing low global bond yields. We're seeing yields head lower here in Australia. Some of the recent headlines across the last week have been concerns around the US Treasuries. The yield on the 10 years in particular as a benchmark starting to trend too high on the prospect that the Federal Reserve starts to remove the bond buying or the stimulus program. So we started to see yields in the US on those 10 years trend up towards 3%, but pulled back over the last few days. So as long as I think we see yields tracking at around sort of that 2.75, I think the market will be pretty comfortable with that. But regardless, I think valuations are high at the moment. I think it's supported by low dividend yields, and whether that's the US market or the Australian market. But the reality is top-line revenue growth in companies is fairly limited, and we've had a huge amount of yield compression as a result of global bond yields being low, money flowing into equities, and obviously compressing the dividend yield of equities as the equity valuations move higher. So the short story here is that we think the Australian market's sitting at about fair value. We're looking for it to largely consolidate and to move sideways. The downside risk to the market probably, in our view, isn't much more than about 5%. I don't think that's a reason not to have an exposure to equities at the moment. Our preference is to be weighted towards sort of those names that we see growing earnings into 2014, and in particular some of those stocks that have significant US dollar earnings, and we're owning those names and selling fairly tight covered calls into sort of this November period, and then ultimately allowing for the market to re-accelerate in the early part of the new year as we begin to see more synchronized global growth. Certainly the contribution from Europe, as I spoke about last week, seems to be starting to turn a corner, which is probably just starting to take place at the right time. So retailers in the US overnight had slightly better than expected earnings. And the real focus at the moment, and I think the market will tread water a little bit, is to see what the Fed's plans are to scale back its stimulus efforts. So the Fed is due to release the minutes of its latest policy-setting committee meeting tonight, and the Fed's to host its annual meeting of global central bankers at Jackson Hole. So we'll look for further commentary out of the Fed towards the end of this week. All that doesn't change my view that I think at the most probable course of action is the market really bounces sideways at or near these levels. Okay, let's go to the companies that have reported. The first one of note here is we're going to take a look at AMP. I'll just bring that into screen. So AMP, you may recall, it wasn't that long ago that management downgraded guidance to around sort of 415 to 435 million for the first half of 13. So that downgrade caused this sell-off from this $5 level down to around 420. We've seen the price gradually bounce back, and I think that was largely supported by yield. The stock getting down to sort of around 6% yield now, sitting back at around 5%. So whilst the company beat the downgraded guidance, the reality is that the business is not delivering, whether it be top-line revenue growth or bottom-line profit growth. So, which is consistent with our view that we think AMP is really at best a yield play for another 12 months. And to put some numbers on that, the stock's trading at about 15 times earnings and at about a 5% dividend yield at these current levels. I think it's pretty hard to see AMP trade on a yield much below 5%. So our view largely is that around this 480, 490 level the stock runs into resistance, and I'd expect it to really just bounce sideways, tracking at around that sort of 5% dividend yield in the months ahead. So to put some specific numbers on that, the underlying profit came in at 440 million. Moving on from AMP, so we had Goodman Group report, and the common theme among the property trust sector, and I think Goodman delivered slightly above average earnings growth relative to the other property trusts, but in general we're looking for forward earnings growth in most of the property trusts somewhere between 3 to 5%. Goodman Group coming in slightly at the top end of that range. So where we see value here is at around this 450 to 470 level. The stock starts to yield about 4.5%. We're probably looking at some fair value at or near that range. Now, one of the stocks that we are very active in is Wesfarmers. So its result slightly disappointed the market. The market was probably looking for earnings growth somewhere around 10%. The company did announce a special 50-cent dividend, which I think softened the blow. So even though we've had a little bit of a sell-off here, and keeping in mind the stock's gone ex-dividend as well, the outlook statement for the company probably indicates that we're likely to see somewhere between that 6 to maybe up to 8% earnings growth in the year ahead, keeping in mind that the stock's trading about 18, 19 times F-year 14 earnings, and that puts it on about anywhere from about a 4.5 to 4.75% dividend yield. So at around $39, I think the stock's fair value. Keep in mind that Woolworths is only growing at around 5% earnings, so Coles was still a standout performer within the Wesfarmers result, but those gains that we've seen over the last 2 or 3 years in Coles start to gradually become a little more difficult as they're coming off a larger base. So anyway, from a valuation standpoint, around $39 we think's fair value, puts the stock on about a 4.75% dividend yield. Our strategy here is to own it at or near these levels and sell covered calls up at around the $41 level. We're getting almost $1 for those pushing out into the early part of the new year, and that's delivering us around a 10% cash flow out of Wesfarmers, so increasing that dividend or that cash flow from 4.75 up to closer to 10% and allowing for some capital growth there as well. Moving on from Wesfarmers, Santos reported their result, and I guess the theme here was the underlying net profit came in pretty much in line with consensus, about $250 million. The top line revenue was a little bit, I think, missed on the top line. The outlook statement really is what got investors excited, as the company indicating that the investments that they've made in LNG will start to deliver returns for shareholders in 2014 and 2015. Now again, to put some numbers on that, the stock's trading about 22, 23 times earnings and about a 2.5% dividend yield. So I still maintain that it's the top end of its valuation range. I think if there is a pullback, it would make sense to want to be long Santos into the middle of next year, but we'd look for a better buying opportunity before building an overweight position in Santos again. Also, so that was all in last week's result. This week's result on Monday, we had Amcor come out. Now, the market was probably looking for a result somewhere around 10%. The company delivered earnings growth around 8.6%, $690 million for the financial year. The highlight of the result was obviously the contribution of acquisitions coming through from emerging markets and the company's ongoing focus to grow the flexibles and rigids division throughout those emerging markets. So allowing for the Aussie dollar to be tracking at around 90 cents, if you factor that in, we could see Amcor deliver about 15% EBIT growth in FY14. So, or on a constant currency terms, I think somewhere around that sort of 9 to 10% underlying earnings growth. So from a valuation standpoint, the stock's expensive up here at about 19 times earnings on about a 4% dividend yield, just under 4% dividend yield. But as I've spoken about in previous weeks, the upcoming demerger of the Australian packaging distribution business from sort of the faster, higher growth international side of the business, I think bodes well. So we have been recent buyers of the stock down here at around $10.50, and we've been selling the covered calls at $11 into November. We collect the upcoming dividend, plus we're collecting around about 20 odd cents for those, a little higher than that, around 30 odd cents for those calls. So I'll just double check that call premium that we've been getting for those for the Amcor positions. So yeah, around that 22 cent mark on the $11 Novembers. So again, that's driving a cash flow close to 10% out of Amcor. So we like it from the perspective that the downside risk is reasonably limited as a result of this breakup, but the stock really is sort of close to full value, so our preference is to continue to play it on the basis that it's largely moving sideways from these levels. Also in the earnings results, we had AZJ, so Horizon came out, and I think, putting aside that we had the slight increase in the dividend payout ratio, EBIT essentially was a little bit below or close to meeting consensus forecast of around $768 million. From our perspective, the highlight of the result was the company's continuing to drive costs down, so the margins are increasing, but again at 20 odd times earnings, a 3% dividend yield, the stock's reasonably full value. Our strategy here has been to own it at lower levels, and we've been selling covered calls up at around this sort of 450, 470 level, and I really think that sort of caps the upside growth for AZJ. We'd be significant buyers of it again on any pullback at around 425 if the opportunity presents. Coca-Cola delivered their results. A little bit disappointing here, probably more on the outlook side of things, that we were looking for probably flat earnings growth. The company's guided to the fact that it could be down somewhere between sort of up to 5% in 2014. I do think what we start to see is a much stronger focus on cost control in Coca-Cola. So we saw the net profit come in at $225 million, which was down about 10% on the same corresponding period. Revenue was off about 3.5% to $2.3 billion. They have announced a special dividend of an extra 2.5 cents, so 26.5 cents coming up ex-div. I still think the stock's very well supported down here. Fair value's back up at around $13. I think we'll gradually see the stock recover up to that level, and our strategy is to continue to look to sell covered calls just over $13 as we wait for the management team to really start to sort of deliver those cost control initiatives that start to see forward earnings increase back up to around sort of that 5% to 6% earnings growth into 2015. Oil Search delivered their result. Good bottom line result, met estimates. Top line revenue fell short by around about 4%, but all in all the result looks okay. we also had QBE deliver their earnings results. So insurance margins were a little bit below expectation, and the net profit after tax was down about 6% below consensus. So we've seen the price sell off. We were largely started taking profit in QBE. The company's had a long history of missing their earnings guidance, and in some respects sort of the latest result certainly hasn't added any further confidence to the market when it comes to QBE's outlook statements. Sonic Healthcare was a good result that they delivered roughly a 6% increase in full year net profit, and revenue grew by around 4%. They declared a final dividend of around 37 cents. BHP delivered their result. Now, from a trading standpoint, we were looking for BHP to rally up to around this $37 level. As it hit that price point, we started selling the covered calls. So in most cases, we covered on BHP somewhere around this, anywhere from $35 through to $39. We essentially see this as sort of full value for BHP over the coming months. I wouldn't be surprised to see stock settle back at around $35, puts the stock, nearing on a 3.5-4% dividend yield. We're looking for about 10 to 12% earnings growth in 2014. And we're really looking for a recovery in BHP from that sort of November through to January period. So I think following this result, there's probably little motivation or to drive the share price higher, and I think sort of around this $35 to $36 is about where fair value sits for BHP. So from a specific standpoint with the results, they missed their full year earnings expectations. They delivered attributable profit of around 11.8 billion for the half. The full year result came in, just to give you some exact numbers on that, at a higher result. I don't actually have that in front of me. Here we go. So BHP reported underlying full-year EBIT of $21 billion, but higher tax and interest saw underlying net profit after tax print 4% below forecasts. From a valuation standpoint, as I alluded to, BHP trades on about 12 times earnings on current numbers, puts it on just under 4% dividend yield, and looking for around that 12% earnings growth into 2014. And then finally, just to conclude, so Suncorp delivered their result, came in line with expectation and declared the special dividend, but essentially that was already forecast by the market. We saw Sydney Airports deliver a reasonable result. Woodside Petroleum, probably the other one of note here. The result came in a little bit below expectations. From a valuation standpoint on Woodside, we have it trading at about 13 times earnings on just under about a 6.5% dividend yield, and we're looking for about 10% earnings growth into 2014, following the outlook statement from the company that earnings growth into 2014 may come in sort of more around that 7 to 8%. All right, so just to conclude tonight's presentation, and obviously throughout earnings season we've got a slightly different format to the presentations, where we tend to just focus on the companies that have delivered earnings results throughout the week. Once we get onto the other side of earnings, we'll do a full summary of the top 50 stocks and focus on what our specific investment strategies are and the derivative overlays. But just to recap some of those strategies within the last week, and I'll just so Amcor we've been buyers of. As I'd mentioned, so at around this 10.50 level, we've been buyers of Amcor, and just today we started selling the $11 calls. ASX we've been buyers of ahead of the upcoming dividend. We're really looking for this stock to largely move sideways, and we're trying to sell covered calls up at around this $37 level. Again, we see limited earnings growth for ASX, but we also do not see a lot of downside risk. So it's one of these income plays where we own the stock, collect the dividends, sell the covered call. We're driving around 10% income out of ASX. BHP, as I'd mentioned, we've been owners of that at lower levels. We started selling the covered calls with the stock up on its highs here. We're getting around $1 for the $38 Novembers. So effectively, coming into November, if the stock was to finish at around 38, it gives an effective exit price of around $39. If, on the other hand, the stock bounces around within our target range of this sort of 35 to 36 level, we've increased that cash flow from around 4% dividend yield to in excess of 10%, and our base case is that BHP largely moves sideways from here, and the next leg up doesn't occur until probably sort of December through to January. Computershare went ex-dividend today, and I spoke about the earnings result last week. So Computershare slightly disappointed, where the market was looking for sort of 10 to 15% earnings growth, came in at sort of the lower end of that range, and on a forward outlook, the company will probably be struggling to deliver sort of that double-digit earnings growth. So what that means is Computershare's gone ex-div 14 cents. We still maintain that the stock's actually quite reasonable value down here, and we're buyers of it at this level, around $10.50 to $11. We look to sell covered calls. We don't see much growth in Computershare beyond that. CBA, we've been owners of CBA at lower levels. We'd sold the 72.50 covered calls into September. We collected around $1 plus for those. So our strategy there is to increase that cash flow again up to around 10% per annum. We're hoping that into the end of September CBA stays below $72 and we don't have to deliver the stock, in which case we'd take the opportunity to resell the calls. If, on the other hand, we're required to deliver the stock, we do own it at lower levels down here at around $69, but it is ex-div $2 now. Telstra, we'd been buyers of Telstra following it going ex-div, so it paid its dividend of around 14 cents. We're just starting to buy back into it again here at the moment. And our view on Telstra is that, considering the company only delivered, stripping out the NBN payments, about 2% revenue and 2% EBIT growth, I think as we get down to sort of this 5.5% dividend yield, there probably shouldn't be too much more upside for the share price. So keeping in mind that the market's already factored in, up to another 25 basis point interest rate cut in November. So our strategy here is to own it at these levels. We're selling calls out into the early part of the new year at around this $5 level. We're collecting around 16 cents for those. So again, combined with the div, it's boosting that cash flow up to around 10%. And we're really trading Telstra on the basis that it bumps sideways at or near this $5 level. The other names that we've participated in, so Wesfarmers, as I'd mentioned, had gone ex-div roughly $1.03. So we're just starting to look at, for clients that don't have exposure to Wesfarmers, is at around this $39 level to add exposure to Wes, wait for it to rally back up to around $40, sell the $41 calls. WDC, so we've been buyers of that on the lows down here at around this $10.70 level, and just now starting to look to sell the covered calls at around this $11.50 to $11.75 level out towards the end of the year. But Westfield went ex-div roughly a week ago, around 24 cents, and as did Westfield Retail, which paid a div at around 9.5 cents. But we've been buyers of this again at around this $2.95 level. And there we go. So thank you for listening in to tonight's recording. Look forward to speaking again next week.